Good afternoon, everyone. We're just going to give it a few seconds for us to let everyone into the webinar. We'll begin in another 20 seconds. Okay, well, as people are coming in, let me kick it off. So welcome, everyone. Good afternoon to the 2022 Economic Outlook presented by Bank of America. I'm Anthony Forgione. I'm the Director of Business Development for the HIA-LI. And as last year, this program was a success. We are looking forward to the program today. Before we begin, I do want to thank our board members. Many are on the call today. Our board has been our rock. They have supported us truly in the past, and they've really all have stepped up as we've gone through COVID, and their support is well appreciated and their support is well recognized. So thank you to all our board members that are on the call today. I want to quickly just mention a couple of upcoming events. We have a networking event next week on the 15th at Patricia's right here in Hauppauge on Motor Parkway. And then we're also excited to announce that on January 14th, we have our annual meeting and legislative program. And I encourage everyone to attend. The annual meeting will be a hybrid. So if you cannot attend physically, you can register to receive the Zoom link. So before we also begin, I do want to recognize Angie Carpenter, who has joined us on this call. She is the supervisor of the town of Islip. Natalie Wright, who's the Commissioner, Department of Economic Development and Planning for Suffolk County, are both listening and viewing this program. So it's my pleasure right now to introduce Mark Perez, the President of Bank of America Long Island. Mark is also the Long Island Market Executive for Bank of America's private bank. So it's my honor to introduce Mark. Mark?
Hey, thank you, Anthony, and good afternoon, everyone. It really is a pleasure to be here. Although I'm new to the Long Island president role, I and the bank certainly are not new to the HIA-LI. Bob Isaacson, who many of you know, I'm sure, is a member of our leadership team and a close friend and colleague of mine. He serves on the board there. And Bank of America has certainly been a partner and a supporter for many years. So look, it's no secret to any of us the critical role that the HIA-LI plays on Long Island. And you know what I love about it most is that it convenes businesses and entrepreneurs that really make up the heartbeat of all of our communities. And for that, we're really grateful to be a part of this group today. So I'm glad to have the opportunity to bring in Bank of America thought leadership for you all. You know, we've all been faced with hardships and challenges over the last 18 months. And these have been challenges like we've never faced before. And I'm inspired, really, despite those challenges, I'm really inspired to see how the island has bounced back and recovered from that and how resilient we are. And that's why I think partnering today again to present our economic outlook is just so critical and so timely. You know, in just a moment, you'll hear from one of Bank of America's economists. And I hope you pick up a few important takeaways from this conversation as we head into 2022. We'll learn today that there's a real bit of hope, I think, about the future of our economy and what the post-pandemic world might look like. You'll also have a chance to ask questions, so please make sure that you get those ready. We've saved plenty of time at the end to answer those questions for you. You know, the bank will continue to do our part for our employees, our clients, and the community. And we know that delivering resources through our anchor partners like the HIA-LI is just one way in which we can continue to add value. So now I'd like to introduce our speaker. He really is the highlight for today. His name is Alex Lin. Alex is a senior U.S. economist at Bank of America. He provides in-depth research on U.S. macroeconomic trends and policy to our clients. He's also responsible for delivering the firm's GDP tracking model and economic forecasts. And most specifically, he covers inflation and housing data. And inflation and housing data in my day job as a private banker and leading the private bank here is what we hear most from our clients in these recent days. So certainly top of mind. I know we're all looking forward to hearing what Alex has to say. So without any further ado, Alex, why don't I turn it to you?
Sure. Thanks, Mark, and thank you for the introduction. Thanks everyone for joining the call and having me. I hope you're all staying safe and healthy, and are able to enjoy the holiday season that we're kind of heading towards. One sec, let me just share my screen. Okay. Does everyone see that okay? Yeah, so I guess, speaking of the outlook, first, just speaking to just this past year first, it has been a story of a, rapidly reopening economy that has been facing a lot of pressure from supply chains. Demand has been much quicker to rebound, and the supply chain and the supply side of the economy ends up moving a little bit more gradually. The good news is that we go into next year is that we do expect some rebalancing and some normalization between supply and demand. The bad news is that we do think that progress is going to be gradual. And so as we're thinking about the forecast, we do think that we're going to remain in this environment of elevated growth and inflation. Specifically for growth, we're expecting 4% GDP growth in 2022, and that's down from 5.6%. But remember that we were in kind of a 2% economy in the prior business cycle, so clearly these are still very strong growth numbers. For inflation, we're expecting this year core PC to end the year around 4.4%. Core PC is the main measure that the Fed looks at, or policymakers look at. Then I'll probably slow to about 2.6%, which the Fed targets 2% inflation, so clearly still a very elevated inflation environment. Similarly, we're expecting core CPI inflation, which is the other kind of main inflation measure, to end this year at 5.1% year-over-year and essentially cool to 3.5% by the end of next year. So again, it's just a very elevated inflation environment, but a lot of that, again, is due to the fact that we are dealing with this very strong growth environment too. So, I think it makes sense to first talk about the supply side, given that that's been really kind of the main story, right, this year, all the supply chain bottlenecks and disruptions and all the pressures that's creating. Unfortunately, things seemingly have actually gotten worse, not better. And this slide essentially it gives a good snapshot of all the kind of various things that you can do to track the supply side. So the top left shows inventory to sales ratios on the retail and wholesale level. And you can see that, over the past 2 years, that the retail inventory sales ratio basically collapsed to historically low levels, right? And it's not even close, right? And we have seen a very slight pickup, but there's still clearly very significant progress to make in terms of replenishing and restocking inventories, and it's probably going to take some time. The graph on the bottom left shows some data from the ISM manufacturing survey. What it does is shows commitment lead times. Basically, the time it takes for when you put in an order and you receive the order, right? And it shows various levels of this. It shows production materials. It shows maintenance, repair, and operating supplies, or MRO supplies, and it shows Capex. And this is data through November, so it's as of the latest month. And you can see that commitment lead times for production and MRO supplies, they've just continued to head higher, and it's decisively higher, right? Capex, it's been a bit more gradual, but clearly with Capex, it's also at kind of historically elevated levels. So this suggests that supply chains are still actually slowing down; they're not speeding up. The graph on the top right shows auto inventories. Autos has gotten a special attention, a particular attention this year, given that the kind of demand supply dynamic, the supply disruptions have been the most acute in this sector, right? I'm sure some of you heard about the global semiconductor shortage, and that's affected production essentially. And what's happened is that auto inventories have basically collapsed to historically low levels. The level of inventories is now around 60,000, and when you consider that vehicle sales tend to total around 15 to 16 million per year, 60,000 cars in inventories is extremely low. So again, safe to say that that's probably going to take a while to replenish as well. Another chart that we like to look at is port congestion. So the graph on the bottom right shows the number of ships that are anchored in the water on the West Coast ports of Los Angeles and Long Beach. And you can see that basically over the course of the second half of this year, so the graph shows basically end of 2020 through this year, you've seen just a steady shift upwards in the number of ships that are waiting. Now you have seen a big dip in recent weeks, but this is actually superficial. So what they did is they changed the queuing system. They basically told ships to basically slow down, travel to the U.S. a little bit slower, and also dock farther away from the coast, so that they're not actually counted. So port condition is actually still very, very bad. Now the question is, when might these conditions kind of resolve themselves? Our sense from our transportation analysts is that they basically expect these constraints to continue to put the supply side under pressure through well into 2022. They project at least the first half, and then they do expect kind of some easing in the second half, assuming that demand kind of normalizes. Because one thing that one shift that we've seen is we've actually seen a massive rotation in demand and consumption towards goods during this cycle, during this whole kind of pandemic era, essentially. If you think about the consumption basket, the share of spend on goods has shifted basically 4 percentage points, which is massive. In a normal year, that share basically kind of wiggles around by maybe a tenth or two. So 4 percentage points is a massive shift. So in some ways, you do need to see this demand kind of normalize, shift back towards services. And again, there is that expectation that could happen in the second half of next year and basically ease some of those pressures. And there is a similar story also with autos as well. Our auto analysts believe that production is probably going to be still choppy in the first half of next year, but things will start to move decisively higher in the second half with the full restocking in basically 2023. Now, the other kind of supply story is not just supply chains and bottlenecks, it's also labor supply. What we've seen is that the labor force participation rate has been basically sticking to the low side. We did see kind of an initial rebound, but since then it's been just a very gradual creep higher. And so there are still tons of workers staying on the sidelines. Now, we do think that COVID has been a big factor. One of the surveys that the Census Bureau started producing during the pandemic is called the Household Pulse Survey. And it is a biweekly survey, and it can be a bit sporadic, but the latest data point is as of mid-October. And what it showed was that there were still 3.7 million workers that were not working due to either having COVID or taking care of someone with COVID. And there are 2.5 million that aren't working due to COVID concerns. So basically around 6 million in total. Now, the decline in the labor force has been, at this point, on net, maybe about 3 to 4 million. So there is a bit of a disconnect in terms of those numbers, but I think it's safe to say that COVID does probably explain a lot of why there's so many people that haven't returned to the labor force. The expectation, of course, into next year is that hopefully we'll continue to get past the pandemic. Hopefully we continue to get past the virus, and so it will allow more workers to come back. Although ironically, one of the factors that might actually be a limiter is actually the vaccine mandate. There actually have been some commentary from the Fed's Beige Book, which they basically kind of ask businesses about what they're thinking, and many businesses actually flagged that they're concerned that the vaccine mandate can actually slow the return in the labor supply, given that many Americans are actually opposed to the vaccine. So we'll have to see how those kind of crosswinds kind of shake out, but on balance, we do expect that the labor supply does have scope to improve in the near term. Again, depending on COVID and the pandemic also progressing. But there are some potentially longer term challenges for the labor supply. One is that we have likely seen a lot of early retirements. One thing that has also occurred alongside this pandemic is we have seen this massive creation of wealth, right? The stock market has been doing very well. Home prices are up 20% year over year. So the housing market is also doing very well. And so many older workers probably were like, financially I'm good. Maybe I don't actually have to work anymore. So those people are probably not coming back. We're also dealing with this theme called the Great Resignation, where basically people have reassessed their careers and now they're thinking about other jobs. Maybe they don't want to go back to the office. Maybe they've really enjoyed the remote environment. And so what you're seeing is that the quits rate, the level of quits and the rate of quits has been increasing. The job turnover rate is increasing as well. You can see that in the graph on the top right of the slide. You can see that both the quits rate and the job openings rate are now very high. And so that has put a lot, again, that has contributed to a lot of the pressures that we're seeing in the labor supply and in labor market dynamics. And you also have kind of this longer term, secular trend of that we are dealing with an aging population. And so if the population continues to age, that means that, more of the population just gradually will shift towards retirement. And that, puts additional pressure on the labor supply. And in recent years, immigration has also been weaker, and that's generally also an important force. So the bottom line is that, while we do expect labor supply to come back, and that's, again, going to ease some of the pressures and frictions that we're seeing, it's not going to fully come back. And so ultimately, that's probably going to put a lot of pressure on wages. So turning over to demand, we think the fundamentals for the economy are still very strong. The consumer is 70% of US GDP, so it's the main driver of growth. And the consumer is just positioned completely different than it was in, say, the post-financial crisis period. The graph on the left shows the personal savings rate. And you can see that during the course of the pandemic, it spiked pretty significantly, right? A lot of that was the fiscal stimulus that we've seen, which was very powerful, very aggressive, and very supportive. And if you basically kind of think about the area under that line, essentially, so if you compare how savings actually evolved versus kind of the pre-pandemic rate, and you kind of add up the difference and consider that kind of excess savings, the data would suggest that consumers have accumulated more than $2 trillion in excess savings. So again, we think that that's very powerful. It basically provides tons of dry powder for the consumer to spend in the future. Another perspective is if you look at commercial deposits. The graph on the top right shows that you can see basically a level shift higher, right? I think it's about $4 to $5 trillion higher than it was pre-pandemic. Now, part of that is just kind of trend growth, but again, it points to the idea that the consumer has built up a lot of savings and a lot of, again, potential to spend. Now, all this excess savings is not even to mention the fact that, and I kind of mentioned this earlier, that household wealth has also exploded higher. The graph on the bottom right shows household net worth, so it's assets minus liabilities, and you can see that it dipped a bit during the pandemic, but it's really just shot up since then. It's now about at 780% of disposable income, which is kind of how we like to look at it. You got to scale it, and that's up from 710% pre-pandemic. Now, I just want to quickly compare that to the post-financial crisis period, right? You saw that there was a big dip, right? And it basically took a full decade after the financial crisis for household net worth to basically get back to where it was. So again, it's a very completely different environment. The consumer is positioned very well, and so we are very optimistic about consumption as we think about next year. Another tailwind for the economy is Capex. So I talked about the fact that we have seen this massive rotation in goods in spending towards goods, right? And so that's actually, that's of course supported the goods producing side of the economy and therefore Capex, right? Because you need Capex in order to increase production and produce these goods. So the graph on the left shows two of the kind of monthly indicators, the high frequency indicators that we like to track in real time: core capital goods orders and core capital goods shipments. And you can see that since the pandemic, it's just been almost completely vertical, right? We've seen a huge surge in shipments and orders. So Capex has been booming. And, kind of the point that I was making in the last slide, right? Just look at the post-financial crisis period. Core capital goods orders and shipments more or less moved sideways, right? So the environment was actually very tame for Capex in the last cycle. So, and then that stands as a stark difference to this cycle. We're still thinking about inventories, right? I talked about the fact that inventories are now at historically low levels, right? That needs to be replenished, that needs to be restocked, and so that just adds another tailwind to the kind of view around the capex trajectory. Another other things that we like to look at for capex is you can actually ask businesses how they're thinking, right? So there are a lot of various business or regional surveys, manufacturing surveys that are produced, and they ask their respondents about Capex. And the graph on the right basically looks at what the latest readings are, that those dark blue bars, and compares it to where it was pre-pandemic, so those light blue bars. And you can see across the board that manufacturers and businesses are expecting stronger Capex going forward. So again, Capex we think will be an additional tailwind supporting the consumer. Now, all this pressure, of course, with supply and demand, one of the consequences is that we have seen a return in goods inflation. One thing I want to point out in this graph on the left is if you look at the kind of 2014 to 2019 period, core goods inflation was essentially actually contributing slightly negative to broader inflation pressures. And this could, I think, largely reflects kind of more secular, themes such as globalization and technological innovation, because inflation is a measure of constant quality. So basically, if the quality improves, that's actually deflationary. So again, this environment is very different. You've seen core goods inflation shoot up significantly higher. Now, autos has been a big story. I touched on autos earlier, right? So one thing that you can do is you can strip out autos from the core goods measure. But you'll still see that core goods ex autos inflation has also accelerated meaningfully. It's now operating at a 4% year-over-year pace, which again is high. So the bad news is that we're actually not done with autos inflation. One of the kind of leading indicators we like to look at is wholesale prices, as measured by Manheim, and that's that light blue line on the graph on the right. And what you can see is that we've seen basically since September, a third wave of strength. If you compare the gains that we've seen thus far, and the data is as of mid-November, prices are up 17% on net since the prior high in May. So again, it's just you're just seeing another unprecedented wave of just price strength in the auto space. There are some lags into retail prices. So the dark blue line shows CPI used cars. We are getting the next release this Friday, but the point is that we haven't seen that just yet, and it's going to likely materialize. So we are going to likely deal with some more elevated inflation readings over the next few months, reflecting a lot of the used car strength. Now thinking about next year, again, I've talked about our belief that supply chains are likely to make progress in terms of kind of normalization process. But again, we think it's probably going to be gradual. It's more of a second half story. And so as we're thinking about core goods inflation, I think it's more likely than not that, it's still going to be very hot. It's still going to be positive. And so that's going to be something that's contributed to this elevated inflation outlook that we're expecting. One change in all of this, though, of course, as we think about next year, is that it's not just used cars anymore. It's not just core goods anymore. We've actually seen a broadening out of inflation pressures. And the way that you can see this is if you look at alternative measures of inflation. One of them is the trimmed mean PCE. What this does is it excludes the noisiest component. So it looks at kind of the middle of the distribution to track kind of, again, it's the underlying price pressures. And what you've seen in recent months is that that's actually spiked. That light blue line on the graph on the left. It's now at 2.5% year over year, which puts it at the strongest level since basically the early 2000s business cycle. So again, we are seeing a broadening out of price pressures. Another way to look at this is to also look at the share of the consumption basket that is seeing an inflation rate above a certain level, right? So the graph on the right shows 3%, 5%. Now the graph is smooth, but basically what you're seeing now is more than half of the consumption basket is now seeing more than 5% inflation. So again, you're seeing a lot of categories that are contributing to this elevated inflation environment. And so I think you probably heard a lot of this kind of debate around transitory versus persistent inflation pressures this year. Basically now one of the stories for next year is that we will see more persistent. The composition of inflation is going to shift, and it's going to be more persistent inflation. Some other kind of factors to consider when thinking about the persistent inflation environment is inflation expectations. So in some ways, inflation expectations can be kind of a self-fulfilling prophecy. If people expect higher inflation, then there tends to actually be higher inflation. The graph on the left shows a kind of summary measure of various inflation expectations measures. This is something that the Fed produces. And what you can see is that you've seen this massive move higher over the course of the past year, essentially. Granted, this measure is a bit lagged. It's only through the third quarter. But clearly, again, you have seen this massive move higher. We can look at kind of some of the inputs or some of the other kind of major inflation expectations variables to get a sense for how things might continue to evolve. The top right shows two measures from the Survey of Professional Forecasters, which basically captures economist expectations. And you can see that for the 10-year CPI measure, that dark blue line, it's actually rebounded to the highest level since 2002, I want to say. Meanwhile, the 10-year PC measure, that's actually accelerated to 2.3%, which is the highest since its limited history back to 2006. So economists are now actually believing that we're going to be in this higher inflation environment. Markets are also now expecting higher inflation as well. The bottom right shows two measures of market-based expectations: the five-year forward break-even, which is basically expectations of 5-year inflation, but 5 years from now. So again, it's a measure of kind of long-run inflation expectations. And then you also have the 10-year break-even rate, and you can see that those also have seen a decisive move higher. So overall, we are dealing with inflation expectations being higher, and again, that supports this idea that persistent inflation next year will also be higher. Two other factors are for persistent inflation pressures, and again, why we believe that they'll be higher next year, is wages and rents, right? So wages also have kind of a positive feed through to prices, and what we see, and the graph on the left shows two of our preferred wage measures: the employment cost index and the Atlanta Fed wage growth tracker. And we like these two indices because they tend to control for a lot of compositional shifts that can kind of create some noise in the wage data. So we think that these are better measures for underlying wage growth. And for the employment cost index in the last reading as of 3Q, we did see a big shift higher to 3.7% year over year. And that's the high since basically the mid 2000s. The Atlanta Fed wage growth tracker has similarly moved up. It's a bit more gradual because we do actually smooth it. It tends to be kind of choppy, but that's moved up to about 3.6% year over year as well, which matches the prior cycle high. So we are seeing wages continue to accelerate, and we do think that there's scope for further acceleration. I've talked about some of these labor supply issues, but we also expect kind of more traditional tightening in the labor markets via the unemployment rate as we get into next year. I think we're expecting the unemployment rate to essentially fall below 4% by early next year. So again, suggesting that the labor market is actually tight, and so we think that wage pressures could reach up to kind of this 4% year-over-year clip, which would again feed back into stronger inflationary pressures as well. We also like to pay a lot of attention to rents because this is the biggest cyclical driver of inflation, and more recently, owner's equivalent rent and rent of primary residence, which are kind of the two big components within CPI, they've accelerated to kind of this 0.4% month over month kind of trend, which puts it higher than it was in the prior business cycle. And we can look at higher frequency market-based rents to get a sense for how these rent indicators are going to evolve. So looking at things like Zillow rent prices or apartment list rental prices, what you've seen is that they're growing actually at a double-digit pace, at more than 10%. So again, what that suggests is that the near-term rental outlook is also going to be very hot, and so again, it's going to be something that supports broader inflation pressures and will signify again this takeover of persistent inflation pressures versus pandemic-related inflation pressures. Now, what's the Fed to do about all this? So recently, the Fed has actually pivoted hawkishly in their communication. What they've said is that they want to retire the term transitory, and they have spoken to the fact that inflation pressures have been broadening out. That there's this idea that persistent inflation pressures are building, and so one thing that they've signaled is at their next meeting is that they're going to speed up the taper process. In our view, our base case is that they're probably going to double the pace. And when they announced in November, they basically said that they're going to reduce Treasury purchases by 10 billion, MBS purchases by 5 billion. We think they'll double that to 20 billion and 10 billion. And what that does is that leaves them on track to actually finish asset purchases in March. What that could potentially mean is that they actually start hiking rates in March. Now, we haven't adjusted our base case on the rate hiking cycle just yet. We think that they'll start in June and then proceed on kind of a quarterly pace, hiking rates by 25 basis points every time. So if they do start in June, that means that they're going to hike 3 times next year, 4 times in 2023, and we think they'll probably stop with one more hike in 2024 to get basically the Fed funds rate to 2 to 2.25%. But we do think that March is going to be a close call. So if that's the case and they end up pulling forward, then that would mean probably 4 hikes next year and 4 hikes in 2023. So, in considering rate hikes, the Fed does face somewhat of a balancing act, right? So I talked about a lot of the labor supply issues, and I talked about the prospects for a lot of these people to actually come back once we get past COVID, hopefully. So, the Fed is also cognizant of that potential shift as well. So they do want to, they feel like they need to be a little bit patient, but at the same time, these supply side challenges, I talked about all the supply chains and the fact that they're actually kind of getting worse, right? Rather than improving. A lot of these issues aren't going away. And so this elevated inflation environment that we're in also may not be going away, right? The inflation risks are growing. And so, the risk then is that, if they need to respond to inflation, then that means that they do need to tighten a little bit more earlier. They need to be a little bit more aggressive in terms of normalizing policy. So that concludes my prepared remarks. So happy to switch over to Q&A and answer any questions that you guys might have.
Thank you, Alex. That was some wonderful information, and we do have some good questions. So why don't I read a couple of them that we received. The housing market has been red hot. Should we be worried that there's a housing bubble forming? And how do you expect the housing market to evolve from where we are right now?
Sure, no, that's a really good question. You're right. The housing market is extremely hot. I mean, home prices have been up 20% year over year, which is insane. I think I want to say that that's actually the record high for the year over year rate. But while things have been very hot, at the same time, we don't actually think, or we're skeptical to believe that we're actually in a housing bubble. And there are a number of factors to kind of consider here. First is that we've actually been, over the past decade, in a period of underbuilding. If you think about housing starts, right, when people actually put shovels into the ground, the historical average has been about 1.5 million per year, and we never got to that point over the last decade, right? So, and as that happened, housing inventories, right, the inventory of existing homes, actually continued to head lower, and it was pre-pandemic was already actually at historically low levels. And since the pandemic, with all the, just the strong housing demand that we've seen, those inventory levels have just continued to push lower. So we are dealing with a very, very tight environment from a supply demand perspective. So it's almost like housing is kind of a microcosm of what we're seeing in the broader economy. But also on the demand side, right? So just thinking about, who's actually buying these homes, right? So mortgage lending standards have actually tightened on net since the pandemic. And right, I think there maybe are little signs that that's eased a little bit. It's still on net tighter, right? And that's after all the tightening that we saw over the course of the last cycle, right, post-financial crisis and all the regulatory changes and whatnot. So if you think about the median FICO score of mortgages, I think it's somewhere in the high 700s, which basically says that all the people that are buying homes right now are very pristine borrowers. They're very high quality borrowers. And so you aren't seeing kind of a ton of speculative activity that would suggest that you are dealing with just irrational exuberance or potentially a housing bubble. Now, of course, 20% year-over-year gains is just not sustainable, right? So our expectation is that as we go into next year, that you probably see some cooling in home price gains. I would also add that one of the factors that has supported home price gains this year is that interest rates have also fallen to record lows, right? So that provides a huge affordability boost. If you're thinking about, the inputs into kind of into your mortgage payment, right? Interest rates are of course one of them. And so just mechanically all else equal, if interest rates go lower, then that actually does allow for home prices to rise. So that's been a contributing factor. Now, I just talked about the Fed and the fact that they're probably going to start hiking rates, right? So you are going to see that become, switch from a tailwind to a headwind. And so that should be something that contributes to cooling in home prices. But again, given these supply demand dynamics, we think that home prices will still have scope to maybe increase by another 10% next year.
Okay. Next question we have, you mentioned that consumer fundamentals look strong. Does that mean we are in for a strong holiday shopping season? What are you seeing on that front?
Sure. Yeah. So, we've definitely been paying very close attention to the consumer. One of the most highly followed reports actually from our team is called B of A and USA, which utilizes the BAC credit and debit card spending data. And so, one thing that's been a change in this holiday shopping season, right, is that, again, we are dealing with these supply constraints. So retailers basically kicked off the holiday shopping season back in October, and they cautioned consumers, hey, you guys need to start buying because you may not get your stuff in time. And so again, going back to the card spending data, we did actually see October come in very strong. Retail ex auto sales, based on our card data, I think rose by almost 1% month over month. The official data from the government, the Census Bureau data, showed an even stronger increase. It was, I think, around 1.7% month over month. So consumers did really actually pull forward their spending. Now, the question is, if they did pull forward their spending, does that mean that November ended up being weaker, right? Because you just see kind of a shift in the timing. But we did actually just tally up the numbers for November, and November is also very strong. Excuse me. We're based on our card data, we think that retail ex auto sales could end up being up another 0.9% month over month, right? So again, and we'll get the official government stats next week, but again, it's indicative of just a very strong holiday shopping season. Now, of course, we are dealing with this elevated inflation environment, so to some extent, prices are to some extent explaining some of the increase, but we don't think it explains all of the increase. And we do think that it is the case that real demand from the consumer is actually very strong, and we should be ending the year in a very strong note.
Good. Next question. You touched on Omicron, COVID, the new variants that are potentially coming out for a little bit. Mm-hmm. How should we be thinking about the risks, and what is the potential impact on our economy?
Sure. Yeah. I mean, certainly, Omicron in recent weeks has definitely received a lot of attention. We're paying, it's a big focus for us. It does seem like there's still a lot of unknowns, but I think the early signs suggest symptoms do tend to be milder, and the vaccines are still effective. So, I think there are a couple of ways to think about the potential impact and feed through into the economy, right? So we have been seeing travel restrictions. That's of course bad. But we wouldn't expect the government, at least in the U.S., to impose very stringent measures like what we saw in lockdown, certainly. So there are, I guess, two other reactions that you have to probably be a little bit more concerned about. One is the consumer reaction, right? So COVID does impact how consumers allocate their spending, right? If they're more concerned, they're probably not going to go. They're not going to be out and about. They're not going to travel. So you see travel and leisure hospitality spend become more subdued. And you did see that right in the summer as Delta cases started to increase. You did see a slowing in services spending, and that means more, potentially good spending. But in the aggregate, probably more of a subdued trajectory. That's kind of the first response. So that clearly we haven't seen that just yet. We just talked about the holiday shopping season and how strong it's been. But maybe around the turn of the year, maybe we could see some softening. So that's going to be something minor. The other is just the supply side challenges, right? So I already talked about the labor supply and how COVID is likely contributing to people staying on the sidelines, either due to COVID concerns or if this vaccine mandate actually goes into effect, that might actually ironically deter some people as well. But you actually have to think not just in the U.S. but globally as well, right? So one thing that we saw in Delta is that there were actually a lot of factory shutdowns in Southeast Asia, where a lot of those countries are very critical to global supply chains. And so that just caused additional disruptions to supply chains and the bottlenecks that we've been seeing, and it's been adding to the inflationary pressures. Again, for now, a lot of it is still unknown. It's still kind of early. For now, we assume that Omicron will end up being kind of a modest headwind. But again, we're going to have to continue to monitor the risks.
Okay. Can you discuss how the Great Resignation and desire to work from home are impacting both the labor force and the housing market?
Sure. So, I'm sure you've all kind of experienced or have your own personal anecdotes, but, people have been quitting left and right, and this Great Resignation. I think the shift to work from home has actually been a huge factor. It revealed that, people could live and work in a completely different way than before and still be highly productive. Working from home can be very comfortable, and just think about all the hours that you save from not having to actually commute. So, I think one of the consequences with the reopening and this realization is that a lot of people just straight up don't want to go back to the office. For older workers who are probably more concerned about COVID than younger people, right? They've also benefited from a lot of the wealth creation that we've seen that I touched on earlier with home prices and the stock market. And so the prospect of having to return to the office, probably, they were probably like, you know what, I'm okay. And for younger workers, many may have, reassessed their careers and start to pursue jobs where that would allow them to be partially or fully remote once the economy kind of got back to normal. So again, and I kind of touched on this earlier, this whole great resignation and this shift to work from home has resulted in a lot higher quits rates, a lot higher labor turnover, and also has put pressure on the labor supply. And all this is contributing to stronger wage growth. What it also did, right, is that it opened up the possibilities for where people could live. Even early on in the pandemic, what we saw is that we saw this massive migration away from the high cost cities to the suburbs, the surrounding suburbs, as well as lower cost cities. Now, in some ways, this actually was accelerating a trend that we were already seeing pre-pandemic. After all, millennials are now getting into those prime, years where they're thinking about buying a home, starting a family, and and high cost cities are a lot less conducive for doing that. So, and so as you saw this massive migration, housing demand in those suburbs, in those surrounding areas, and low cost cities, that was just very strong throughout. Now, with the reopening, it's natural to see some of that pressure come off, right? Because there are going to be people that go back to the high cost cities, and why not, right? Like landlords were offering crazy amenities and discounts like 4 to 5 months off, right? So why not take advantage of those crazy discounts, right? But I do think that there's going to be some permanence in this work from home shift, and so there is going to be some stickiness to the migration that we have seen towards these lower cost cities to the surrounding suburbs.
Okay.
And that's going to again support those housing markets.
Okay. Here's $1 million question. With rates expected to rise in 2022, with inflation expected to rise in 2022, with the supply chain being affected until half the year, what's an economist's forecast or view of the stock market in 2022? Are we looking at a level stock market? Are we looking at the potential for another major correction? What's your view?
Yeah, no, that's a good question. So we actually do have equity strategists who think about this a lot, and they're definitely not as rosy about the stock market as we are about the economy. I think you raise a good point in terms of the fact that we are seeing rate hikes most likely, right? So that's going to basically kick off a period of tightening in financial conditions, and so that might not be something that's very favorable for equity. So my sense from what our equity strategists have been saying is that they're definitely a lot more cautious about the stock market going forward, and potentially bearish. And I don't think we can dismiss the risk of a potential correction, as those things have historically tended to occur at times when the Fed is actually kicking off that rate hike cycle, when we are actually seeing that tightening of financial conditions. It's oftentimes not really a smooth process.
Right. Okay. Actually, right now, the last question I have, and if anyone has any questions, please put it in the Q&A field, is after above average growth powered by the rebound from last spring's pandemic-induced downturn, Long Island recovery has slowed a bit. Monthly payrolls alternated between gains and losses from September to March, with consumer industries backtracking more noticeably than they are nationally. What is some of the factors that might impact job growth in 2022?
Sure. So, it's hard for me to speak, I guess, regionally, but I can certainly talk about, labor dynamics on a national level. And I've already kind of reiterated this point, but the biggest factor is ultimately going to be COVID, right? So COVID affects labor demand as it does labor supply, right? On the labor demand side of it, right, COVID influences what consumers actually want to spend their money on, right? Is it goods? Is it services? One of the sectors that's been most depressed, right, is the leisure and hospitality sector. And what we've seen, over the past year, right, is that a lot of the swings in aggregate hiring are dependent essentially on the swings that you see in the leisure and hospitality sector, right? And so, as getting into the summer before Delta really became a problem, job growth was very strong. As Delta cases really started to rise, people got worried and people pulled back. job growth started to slow. And now that we've kind of gotten past the Delta wave, there are signs that job growth is starting to pick up a little bit, but now we're dealing with this Omicron variant, right? So again, COVID does actually impact the aggregate hiring, right? It influences, because we really do need to see this kind of rotation back towards services, which remains largely depressed. And then again, on the labor supply, right, it actually prevents people from coming back into the labor market, right? And so I think one thing that was particularly interesting in the last labor market report, we saw household employment actually shoot up by 1.1 million, but we also saw labor supply grow by, I think, somewhere like 600,000, right? So I think it is the case that there was this big pickup in labor supply, and that allowed for a big acceleration in hiring. So again, to the extent that we get past COVID and a lot more of the labor supply actually starts to come back, right? Because there's still millions of workers that are sitting on the sidelines relative to pre-pandemic. That's going to allow for also just stronger hiring in general.
Well, I hope that's the case, because I will tell you, hearing from our members, both in the hospitality and the manufacturing worlds, they're having so much issues just trying to hire people and get a labor force in there. So let me take a look. Well, that is all the Q&A I have right now. There were some good questions though. So what I'm going to do is I'm going to thank you, Alex, for your expertise this afternoon. This will be made available, recording. So please, it will definitely go on our YouTube. Please feel free to share it, because I think there's some valuable information that came out of it. Also want to thank Mark Perez for his opening comments. And I want to thank everyone who has been in attendance today and joined us for this wonderful program. So thank you, Bank of America, and thank you, Alex.
Yeah, thanks for having me.
All right. Have a good afternoon.
You as well. Thank you.
All right.